Welcome to the deep dive. Today we're tackling something that's really been making waves in the financial world.
Oh, yeah. What's that?
Donald Trump's recent and pretty direct advice to buy stocks.
Ah, yes. That definitely caught my eye. Bit unusual.
Right. So we've pulled together some really interesting sources. There's a great YouTube analysis from Madeline Bose, brings in different experts, looks at current events.
Okay.
And our goal today is really to dig into what Trump's suggestion might actually mean when you look at the bigger picture.
The broader context, like global economy shifts, central banks.
Exactly. Central banks, how investors are feeling, all of
Yeah.
that. Okay, let's try and unpack this then.
Sounds good. It's certainly, well, a bold move for a former president to just come out and say buy stocks so publicly.
Yeah, it makes you stop and think.
Definitely. You have to wonder, what's the real motivation here? Is it simply, hey, let's help everyday folks build wealth? Or, could there be something more strategic going on? Maybe trying to prop up the financial system, especially with the dollar looking a bit softer and the bond market.
Right.
Well, it's not exactly firing on all cylinders right now,
Right. It feels like there are layers to it.
for sure.
And that softening dollar, it just keeps coming up in global economics, doesn't it?
It really does. We're seeing reports, Russia, China, they're increasingly looking to settle international deals in their own currencies, moving away from the dollar.
Which interestingly kind of aligns with something Trump himself has talked about before.
A weaker dollar idea.
Yeah, a weaker dollar to help American manufacturing, boost exports, give U.S. goods an edge.
True, but then that has knock-on effects, right?
Absolutely.
Yeah.
Here's where it gets really interesting on the global stage.
Because a weaker U.S. dollar means a stronger euro, for instance.
Exactly. And while that might seem good on the surface, think about European businesses. The euro's up, what, about 9% against the dollar in the past year?
Wow, 9%. Okay.
So, great if you're a European tourist heading to the U.S., maybe. But for European companies selling stuff to the U.S., it's a challenge.
Right. Their products suddenly cost more for American buyers.
Precisely. Think about the big players, Heineken, Porsche, SAP. The analysis we looked at points to some potentially serious hits.
Like how serious?
Well, one example mentioned a possible 180 million loss. Another talked about a 1.25 billion write-off. Even HelloFresh is voicing concerns about profit impacts.
Yikes. So a weaker dollar might help U.S. exports, but it's definitely causing some pain across the pond.
No doubt about it.
And this whole thing just highlights how interconnected everything is. Global trade, tariffs, it gets complicated fast.
It really does. The U.S. puts import tariffs in place.
Which then makes investors maybe a little less excited about holding dollars or U.S. Treasury bonds. Demand dips.
And when demand dips for bonds.
Yields tend to creep up. We're seeing that with U.S. Treasuries.
Right.
Plus, the European Commission hasn't just sat back, right? They've got their own retaliatory measures.
Which just adds fuel to this whole potential trade war scenario.
Exactly. Klasnot, the head of the Dutch central bank, he actually warned about that specifically. A trade war.
Yeah, I saw that. And economist Lex Hugduin suggested these tariffs could even potentially trigger a slowdown, maybe a recession.
How so?
His point was the uncertainty. Businesses get hesitant, they delay investments, they just wait and see.
Wachten is that niks gebeurt, as he put it. Waiting means nothing happens. Investment stalls.
Right. And the Dutch finance minister, Elko Huygen, used that strong word, warning about an impending clap.
A hit. An economic blow. Yeah, that doesn't sound good. The potential fallout seems pretty serious.
Definitely.
And all this uncertainty, these headwinds, it puts central banks in a really tricky position.
This balancing act they have to do.
Right. We just saw the European Central Bank and the Bank of England cut their interest rates, only by 0.25%, but still.
And that seems to be a wider trend globally, doesn't it? Lots of central banks cutting rates.
It does. But here's the bind. They're also dealing with rising inflation. The Eurozone's at, 4.1%.
So they're trying to stimulate the economy or at least avoid a recession by cutting rates, but also need to fight inflation, which usually means raising rates.
Exactly. It's a tough spot.
And you really see how these big decisions filter down. I mean, I saw a report about a commercial bank actually lowering its savings rates, even though the main central bank rates were still relatively high.
The margin squeeze.
Yeah. So if inflation is running higher than the interest you're getting on your savings, well, you're losing purchasing power.
Where savings are effectively shrinking in real terms. Yeah.
Which makes what the U.S. Federal Reserve is doing, or rather not doing, even more interesting.
Jerome Powell deciding to pause rate hikes,
Right,
going against the grain.
right. And his reasoning.
Well, he basically said he wants more clarity on trade policy from the White House first. He sees the potential economic impact of those policies as being huge, so significant it makes setting monetary policy really difficult right now.
It's like trying to drive knowing there's a sharp turn ahead, but you're not sure exactly when or how sharp.
That's a good analogy. You have to anticipate, but you don't want to oversteer too early.
And Tavi Costa made an interesting point here, pointing out the Fed's own forecasts seem to be anticipating stagflation now.
Oof, stagflation. That lovely combo of stagnant growth and persistent inflation.
Not ideal.
Definitely not. And that whole scenario, stagflation, makes you think about where investments might flow. Tavi Costa's analysis is interesting here.
The commodities versus equities thing.
Yeah. Looking at the ratio of commodity prices to stock prices, alongside the dollar index, he suggests we might be near a turning point.
A turning point where commodities start looking better than stocks.
Potentially, yeah. Historically, there's often been this inverse relationship. Strong dollar, commodities look relatively cheap compared to stocks. Weakening dollar, maybe commodities outperform.
Like a seesaw.
Kinda, yeah. We saw similar patterns back in 85, 90, and again in 2020.
Okay, so if the thinking is the dollar might be peaking or starting to weaken,
Then commodities, things like gold, silver, maybe energy, could become more attractive.
makes sense. And we did see a little uptick mentioned in commodity prices recently. A hint, maybe.
Could be. It hints at maybe a shift in where investment money is going, potentially away from equities and into harder assets.
But what's really striking is investor sentiment itself, isn't it? The mood out there.
Oh, absolutely.
Yeah.
The data on U.S. consumer expectations for the stock market is quite something. Back in April, almost half expected lower prices over the next year.
Half. Wow, that's pessimistic.
It's the highest level of pessimism in 14 years. But what's even wilder is how fast that sentiment shifted.
How fast?
The gap between the bulls and the bears, those expecting higher prices versus lower, it dropped by 44 percentage points in just 4 months.
44 points. That's huge.
It's the biggest 4-month drop on record, going back to like 1990 and 2002.
Okay, that's a significant mood swing. But perspective check.
Right. Important to remember, when you look at the actual market dips we've seen recently, they're still relatively mild compared to the big crashes like 2000 or 2008, or even the COVID lockdown shock.
So usually you need a more fundamental economic problem for a massive, sustained downturn.
Generally, yes.
Mm.
But these big shifts in sentiment can sometimes be, the canary in the coal mine, an early warning.
And this cautious mood seems to be reflected in what some big players are doing, like Warren Buffett.
Yeah, definitely worth noting. He's stepping down as Berkshire Hathaway's CEO at year-end, which is significant in itself.
But it's the cash, right, the sheer amount of cash Berkshire's holding.
Exactly. It's ballooned from $63 billion back in 2015 to, wait for it, $348 billion.
Yep, that's more than tripled just since 2022.
That is an enormous pile of cash just
Yeah.
sitting there. Wait.
It really is. And Buffett himself even dropped a hint about maybe needing to hold a lot of other currencies.
Suggesting maybe some concern about the U.S. dollar itself. It certainly sounds like it. Maybe linked to potential big investments overseas, like in European companies, Heineken, ASML were mentioned as examples. If you're planning that, holding euros might make sense.
And there was that chart from Zero Hedge going around showing the dollar weakening significantly.
Right, it wasn't Taiwan's currency collapsing, as some thought. It was showing the dollar's decline. When someone like Buffett makes these kinds of moves and comments, you tend to pay attention.
Absolutely. And adding to this somewhat gloomy picture is the U.S. bond market.
Yeah, that's another area flashing warning signs. It's
Oh.
currently in its longest drawdown ever,
Longest ever. How long?
57 months, and down about 17.2%.
Wow. How does that compare to previous downturns?
Much worse.
Yeah.
Back in the early 80s, there were downturns, but they were shorter, like 16 months, 12 months, and the declines were smaller, around 9% or 12%. This current one is significantly deeper and longer.
So bottom line, bonds aren't looking like a great place to be right now either.
Doesn't seem like it, no. Not particularly attractive at the moment.
Okay. So let's bring this all back around. We have Trump very confidently saying, buy stocks, calling the U.S. economy a rocket ship.
Yeah, very optimistic.
But then we have all these other signals we just talked about. The weakening dollar, trade tensions, wary central banks, plummeting investor sentiment, Buffett hoarding cash, the bond market in historic trouble.
It's quite a contrast, isn't it?
It really is. And look, Trump's obviously had success. He's known for thinking big, being visionary, perhaps.
Sure, his track record in business and politics is undeniable.
But the global economy is just incredibly complex. So many moving parts. You can't just like wish a stock market boom into existence when all these other factors are pointing differently.
Right. There seems to be a real disconnect between that bullish stock call and the caution flags waving in the bond market and from someone like Buffett.
So where does this leave us? What's the underlying theme here?
Well, one major theme seems to be the potential for, or maybe the reality of, rising inflation.
Ah, inflation again.
Yeah. With all the money that's been pumped into the system globally over the last few years, quantitative easing and all that.
Which, just quickly for listeners, quantitative easing is basically central banks creating money to buy assets, usually bonds, to inject liquidity.
Exactly. With all that extra money floating around, finding assets that can actually hold their value or even grow faster than inflation becomes really crucial.
To protect your purchasing power.
Precisely. And you see strategies reflecting this. Look at China. They're doing their own form of QE, printing money, but at the same time, they're significantly boosting their gold reserves.
Gold, the traditional inflation hedge, protecting against currency devaluation.
That's the classic play.
Which inevitably brings us to cryptocurrencies, and
Right.
specifically Bitcoin.
The digital gold argument.
Right. The core idea being its scarcity. There's a fixed supply. Only 21 million Bitcoin will ever exist.
Unlike fiat currencies, which can be printed essentially without limit, there was that striking analogy.
The shipping containers.
Yeah. Thinking about the sheer volume of U.S. dollars printed recently, how many shipping containers you'd need versus the fixed, verifiable supply of Bitcoin, it really highlights the scarcity point.
And adoption is growing. What is it? Over 50 million Americans now hold some crypto?
Something like that, yeah. And we're seeing more institutional acceptance, too.
Like the Office of the Controller of the Currency saying U.S. banks can offer crypto custody services.
Exactly. And huge players like BlackRock basically saying it's now riskier not to own Bitcoin than to own it. That's a massive statement from an institution like BlackRock.
Wow. Yeah. Some are even calling it the gunpowder of the digital era.
Highlighting its potential disruptive power in finance.
And the price action lately certainly reflects something, pushing above $100,000 recently.
Yeah, it's been volatile, but trending up significantly. Looking at things like the Fear and Greed Index can give you a sense of the short-term sentiment swings.
But the longer-term analysis, Pompliano's newsletter was mentioned.
Right. Anthony Pompliano highlighted the long-term correlation between Bitcoin's money supply growth, which is slowing down due to halvings, and its price. That analysis suggests potential for much more upside.
Towards, what, $140,000 or even higher?
Potentially, yeah. Especially looking out towards the typical end-of-market cycles, maybe around 2026, based on historical patterns.
And it's interesting comparing the price in euros versus dollars now with the euro strengthening.
Absolutely. And remember our earlier discussions about the Bitcoin halving back in early 2024.
Yeah, the event that cuts the new supply rate in half.
The prediction was that this supply shock would likely lead to further price increases down the line, and that seems to be playing out.
Technical charts looking bullish too. Monthly, weekly, daily.
Generally showing strong upward trends, yeah. Though there are always key resistance levels to watch. That 140K zone looks like a significant area based on projections.
Of course, how people invest in it varies wildly. Holding long-term, trading.
Right. There are different strategies. And for listeners interested, there was mention of a resource, like a Bitcoin exit strategy paper, exploring some of those.
Okay, so let's try and wrap this up. Where does this deep dive leave us?
Well, I think the main takeaway is just how complex and frankly uncertain the global economic picture is right now. You've got conflicting signals everywhere.
Yeah, it's not straightforward.
Not at all. So, Trump's advice to buy stocks. It's one data point, but you absolutely have to view it within this much broader context. Currency shifts, trade tensions, what central banks are doing or not doing.
And how investors are feeling about everything from traditional commodities to newer assets like crypto. It's all interconnected.
Exactly. It's a mosaic, and you need to look at all the pieces.
Okay, so on that note, here's something for you, the listener, to really mull over. Considering everything we've just chewed on, which asset classes are you watching most closely right now? And maybe more importantly, what specific factors are going to guide your decisions in the coming months?
It really comes down to understanding how these big macro forces might play out and how that aligns with your own individual situation and strategy.
Definitely food for thought. Thanks for taking this deep dive with us today.